In this lecture, we'll be talking about accounting for liabilities that may exist in the future depending on the outcome of a future event. We call these contingent liabilities, and the idea is that whether or not the liability exists is contingent on something else. Our goal here is focused and specific. I want you to be able to decide for any given loss contingency whether the company should record it in the accounts, disclose it in the notes, or not report it at all. To give us some context, let's think about a giant company like General Motors. At any given moment, GM might be exposed to thousands of potential claims: product liability lawsuits, environmental matters, warranty disputes, employment claims, and on and on. Should GM record a liability for every single possible future lawsuit? Of course not. That would be absurd and misleading. So how do we sort through all that clutter? How do we decide what to recognize as a liability, what to flag in the notes as something to watch, and what to simply ignore as inconsequential? Let's start with the definition of a contingency. A contingency is an existing condition or situation involving uncertainty that will ultimately be resolved by a future event. Break that into three pieces. First, the condition exists now. Something is already in place at the balance sheet date, like a pending lawsuit or a product that's already been sold. Second, the outcome is uncertain. We don't know yet whether a loss will occur. And third, a future event will resolve it: a court verdict, a settlement, a claim being asserted or not. A loss contingency then is a situation that might result in a loss, and our job is to figure out how that potential loss should show up, if at all, in the financial statements. The accounting rules are very much driven by the conservatism principle here. So the whole decision comes down to two questions. Question one, how likely is the loss? We sort the likelihood into three buckets: probable, reasonably possible, or remote. Question two, can the loss be reasonably estimated? The answers to these two questions taken together tell us whether to record the contingency, disclose it, or ignore it. So let's put them together into a decision framework. Here's the framework, and it's probably worth memorizing. If a loss is probable, that is very likely to occur, and the amount is reasonably estimable, then we accrue it. That means we record a journal entry by debiting a loss and crediting a liability, and the contingency will show up on our financial statements. If the loss is reasonably possible, more than remote but less than likely, somewhere between, then we disclose it in the notes to the financial statements. No journal entry, but we describe the situation so that the financial statement users are aware of it. And importantly, we also fall into this disclosure bucket if a loss is probable, but we can't reasonably estimate the amount. We can't record a number, we can't estimate, but we still owe users a disclosure. Finally, if the loss is remote, only a slight chance of occurring, then we generally ignore it. No accrual, no disclosure required. So that's the structure. Probable and estimable means record, reasonably possible means disclose, and remote means ignore. Now, I want to talk about the language for a second. Although these three words, probable, reasonably possible, and remote, sound precise, they actually require a lot of professional judgment. Let me show you with a quick thought experiment. Suppose I ask one of you, what percentage likelihood does probable mean? One student might say anything greater than 80%. I ask another student the same question and they say anything greater than 50%. Now suppose our legal team advises us that the probability of losing a lawsuit is 70%. Under the first student's threshold, that's not probable, so we'd only disclose. Under the second student's threshold, it is probable, so we'd accrue. Same facts, different reporting, purely because of a judgment call. Now, as the accountant, you probably won't be the one determining the likelihood of loss. That decision will be up to the legal team and senior management, and you'll be given this information in any homework or exam scenario. But the complexity and subjectivity is worth noting. Let's put this framework to work in a real example. We're going to look at 4 different scenarios and decide whether or not we need to record it, disclose it, or ignore it. The first scenario says we've got a probable payment of $2.2 million. So probable means we need to disclose it, especially if we can reasonably estimate it. So we'll do a debit here to a loss, and it could say loss due to liability or loss on contingent liability, but it just needs to be a loss account in the amount of $2.2 million. And we need to credit contingent liability. And the word liability is the important part, for the amount of $2.2 million. The second one is also probable, but they've given us a range. And we didn't really discuss this, but if we have a range, conservatism says we can go ahead and record the lower end of the range. So we'll debit the loss also here for the $1.9 million and credit contingent liability for $1.9 million. The next one is reasonably possible, which means no journal entry, but we do need to disclose this in the notes. So disclosure in the notes. And then finally, we've got a remote scenario. It is a remote possibility that we'll lose $2.2 million in the future. We don't need to do anything. No journal entry, no disclosure. Let's review. A contingency is an existing uncertainty. Whether it will eventually result in a loss is contingent on the outcome of a future event. How we account for the possible loss depends on the likelihood of the loss and whether it can be reasonably estimated. Assuming it can be estimated, a probable loss needs to be accrued. If it's reasonably possible, we only need to disclose it in the notes. And if it's remote, we ignore it, for now anyway. One caveat is a probable loss that cannot be reasonably estimated should also be disclosed. And as a final, very important note, remember that gain contingencies are never accrued. Betting on a future gain is definitely not conservative.